Hello everyone and welcome back. In this video, we are going to start new chapter from the syllabus of BAF and Bcom, that is Buyback of Shares. And this chapter is very easy and simple chapter. So first, understand the meaning of buyback of shares.
Buyback of shares means company repurchase its own share from the shareholder. It simply means that the company is buying back share from the public.
Now, why does the company go for buyback of shares?
The main aim of buyback of shares or repurchase of shares might be to reduce the number of shares, to improve the share price, to increase earning per share, to increase promoters holding, to use surplus cash.
These all are objective or reason why company does go for buyback of shares. Now we will see the legal provision of Companies Act 2013, Section 68. Calculation of buyback. Board route 10% or less of the total paid up equity capital and free reserve of the company. Shareholders route 25% or less of the total paid up equity capital and free reserve of the company. After buyback, the debt-equity ratio cannot be more than 2:1. All the share must be fully paid up. Security premium is not part of free reserve, but for this chapter, for buyback, free reserve also includes security premiums.
Source of buyback. When company go for buyback of share, what the company needs? The company needs fund or cash to pay off shareholder. So, company can buy the share back and cancel it. So, company can arrange those fund or those cash out of free reserve or fresh issue of shares. And free reserves are general reserve, profit and loss account, dividend equalization fund, security premium, investment allowance reserve. But remember, capital reserve and revaluation reserve is not a free reserve.
As per SEBI guidelines provided that no buyback of any kind of share or other specified security shall be made out of the proceed of earlier issue of same kind of share or same kind of other specified securities. It means if you are going to buy back equity share, then you have to fresh issue preference share. You can't issue equity share. What is Capital Redemption Reserve (CRR) and why is it created? In the case of buyback of shares, the shareholders are paid before the creditors. Hence, the amount equal to the nominal value of a share will be transferred and locked into the new account. This new account is known as Capital Redemption Reserve (CRR).
Now we are going to see journal entry for the buyback of shares. And before moving into journal entry, let's see one practical equation, and this equation is itself help us to pass journal entry. Company is going to buy back 20,000 equity share of rupees 100 each at premium of 10%. So what would be happening here? The company wants to buy back those share from equity shareholder. They need to pay equity shareholder. So company is going to pay face value and also the premium amount or extra amount. This extra amount is loss for a company. To write off this loss, company can use free reserves. And first priority to write off this loss, you have to use security premium, and after that you can also use general reserve, profit and loss account, or any other free reserves. Company is also going to pay face value, but in section 68 we have seen that we have to replace this capital. The Companies Act says that the paid up capital should not be decreased, it should remain the same, either by issuing preference share, and another option is free reserve, which is transferred to CRR. The shares which are going to brought back by company must be fully paid. If shares are partly paid, so first we have to make partly paid share to fully paid up. So here is 2 entry for this. On making final call, equity share final call account debit to equity share capital account. Second, on receipt, bank account debit to equity share final call account. To sale investment to arrange cash, entry will be bank account debit to investment. If investment sold above book value, profit and loss account will credit. And if investment sold below book value, profit and loss account will debited. As per nominal rule, we all know that debit all expense and losses, credit all income and gain. So now, next entry is main entry of buyback of shares. Make money due to equity shareholder on buyback. Before journal entry, I told that this equation will help us to pass journal entry. So let's see how this equation will help us. Face value of equity share to be brought back. Face value is 20 lakh plus premium is 2 lakh. Total is 22 lakh. We have to pay equity shareholder 22 lakhs. This is liability for company. So our entry is equity share capital account debit 20 lakhs, premium on buyback 2 lakhs, to equity shareholder 22 lakhs. Right of premium payable on buyback. Here we will give first priority to security premium and then after other divisible profit. So our entry will be security premium account debit, general reserve account debit, profit and loss account debit to premium on buyback account. Creating capital redemption reserve, and reserve always have credit balance. So here we are crediting capital redemption reserve and debit is other free reserve or divisible profit, profit and loss account debit, general reserve account debit, revenue reserve account debit, security premium account debit to capital redemption reserve. Fresh issue of preference share. On receipt of application money, bank account debit to preference share application account to preference share allotment account. On allotment, preference share application account debit to preference share capital to securities premium account. Now we have sufficient amount to pay equity shareholder. So last entry is payment entry. For the payment of equity shareholder account debit to bank account.